In today's analysis, we delve into the intricate and at times tumultuous relationship between global investors and the U.S. government's debt. Why do economic powerhouses like China and Japan invest so heavily in U.S. Treasury securities? What profound significance lies beneath their actions? When the U.S. government finds itself in need of funds, it turns to Treasury securities, essentially solemn promises to repay borrowed sums with interest. For many nations, these securities are not just investments, they are lifelines. The unwavering reputation of the U.S. government for honoring its debts, coupled with the U.S. dollar's dominance in global trade, makes these securities a sanctuary for countries seeking to safeguard their surplus funds with minimal risk. Consider nations that export extensively to the United States. They accumulate vast reserves of U.S. dollars. But rather than letting this wealth sit idle, they channel it into U.S. debt. This strategy does more than yield interest. It becomes a powerful tool to maintain currency stability and bolster competitive export pricing. Holding U.S. treasuries is akin to a nation keeping its emergency savings in a vault of unparalleled security. By investing in these securities, central banks not only preserve their foreign currency reserves, but also earn a return, a critical maneuver to navigate the treacherous waters of currency volatility. To grasp the magnitude of these financial maneuvers, we turn to the Treasury International Capital (TIC) report, a monthly publication by the U.S. Department of the Treasury. This report unveils the intricate dance of nations, the buying and selling of U.S. Treasury securities, and offers a window into the shifting strategies of global investors as they respond to the ever-changing economic and political landscape. Between November 2024 and January 2025, the financial world witnessed a seismic event, a global sell-off of U.S. Treasury securities. In just 3 months, foreign governments and major financial centers divested approximately $390 billion. This wasn't an isolated tremor. It was a coordinated retreat spanning continents, from North America to Europe, Asia to the Middle East. Brazil emerged as one of the most significant sellers, shedding around $55.9 billion in U.S. debt. Financial hubs like Ireland and the Cayman Islands weren't far behind, reducing their holdings by about $42 billion and $41.2 billion, respectively. Even Canada, a nation with deep economic ties to the U.S., surprised many by offloading approximately $37 billion. Norway and India also made substantial cuts, selling roughly $35.6 billion and $34.9 billion, respectively. The United Kingdom, traditionally a steadfast holder of U.S. treasuries, trimmed its portfolio by $26.6 billion, while Singapore and South Korea reduced theirs by $26.5 billion and $22 billion. Even the titans Japan and China, the two largest foreign holders of U.S. debt, couldn't resist the tide, each reducing their exposure by $7.8 billion. Though modest relative to their vast holdings, their participation underscored a global shift in investment strategy. What could drive such a sweeping exodus? Several factors converged to ignite this sell-off. The rising interest rates in the United States played a pivotal role. As rates climbed, older bonds with lower yields lost their luster, prompting investors to purge them from their portfolios. Simultaneously, the robust strength of the U.S. dollar, intertwined with relentless currency market volatility, compelled central banks to recalibrate their reserve allocations, aiming to shield themselves from the capricious swings of currency fluctuations. Geopolitical tensions added fuel to the fire. The Russia-Ukraine conflict and escalating U.S.-China frictions sowed seeds of doubt about the stability and predictability of American financial policies. For many foreign investors, the looming threats of sanctions, asset freezes, and the broader weaponization of finance became too perilous to ignore. In response, countries began to diversify their reserves, reducing reliance on U.S. assets and turning towards alternative currencies, gold and euros, a clear signal of growing unease about the long-term sustainability of U.S. borrowing amidst persistent budget deficits and a swelling national debt. The timing of this sell-off was no coincidence. It aligned with the dramatic return of Donald Trump to the presidential stage in January 2025. International investors viewed his resurgence and his unwavering America First agenda as a harbinger of renewed unpredictability in U.S. economic policy. Recalling his previous term's abrupt policy shifts, tariffs, Withdrawals from multilateral agreements, economic sanctions. Global investors grew apprehensive about the stability and direction of U.S. fiscal policy, prompting a re-evaluation of the wisdom of holding substantial U.S. debt. Compounding this political uncertainty was the specter of impending U.S. reciprocal tariffs, set to take effect on April 2, 2025. Designed to mirror or surpass those imposed by U.S. trading partners, these tariffs aim to protect domestic industries by leveling the playing field for American producers. Yet, the anticipated economic fallout was profound. Domestically, higher import costs threatened to drive up consumer prices, especially for products reliant on imported components, stoking the flames of inflation. Federal Reserve officials voiced concerns that these tariffs could derail efforts to tame inflation in the near term. Globally, the ripple effects were equally alarming. Established supply chains and trade relationships faced disruption. Countries heavily dependent on exporting to the U.S. scrambled to find alternative markets or adjust their trade policies. This upheaval hinted at a reconfiguration of global trade networks as nations grappled with protecting domestic industries while striving to maintain robust international economic cooperation. The European Union, for instance, voiced apprehensions that the U.S. tariff policy might violate World Trade Organization norms, sparking discussions of potential retaliatory measures. China adopted a more aggressive stance, warning of significant economic consequences and imposing its own tariffs on U.S. agricultural products. In Canada, the government initiated public consultations to devise countermeasures.